Hey everyone, and welcome back to another video. In today's lesson, we're going to be talking about the importance of doing good research as a trader. Research is one of those things that every trader knows holds value, that they should be doing if they're trying to forecast the markets. But what we're going to be talking about today is what makes research good. How can we take the idea of research and going out and gathering information and use it to build more confidence in the trades that we take? To start this discussion on research, we need to have a discussion about what makes something good information, right? It's a good question to ask, like what makes something valuable information? And to start off, I think I'm going to tell you a little bit story about a stock that I looked into back in the day. So I was looking into this stock called TM. It was a technology infrastructure company, and they were trading, pretty cheap, around $2. And when I looked at the company, I saw a lot of really cool things. Let's say today is January. And what I could see was that in the next 6 months, they had a lot of really cool catalysts coming up. A bunch of new contracts coming in, a bunch of funding, they brought in a new CEO. There was a lot of things that were going well for this company. Not only that, but there was a bunch of unrealized revenues from the previous year that were rolling into this quarter. And when I looked at all of these positive things that were going to happen for the company, right now I'm on day 0, looking forward, what I see is this. I see the stock going up in value. And this is for a number of reasons, right? Along the way, I see a lot of really great things happening that should continue to push the stock price higher and higher. And I also see a bunch of things from the past rolling into the future that are going to further keep this price going up. So what did I do? On this day here, I bought the stock. And what actually ended up happening, interestingly enough, as time went forward, the stock sort of stayed the same. It didn't really have this rally that I had anticipated. And not only that, when one of these things fell through and didn't happen, the stock took a huge dip. It ended up down here, and it was actually one of the worst trades I've ever taken. But I looked at it and I thought to myself, what happened here? How did I lose money on this trade? There were so many good things going on. And this is why. In this lesson, I'm going to start by explaining what went wrong with this trade. So I had noticed, let's call it 3 things that were going to happen, right? There was 3 events that were going to really drive up the price of the stock. And we're on day 0. On day 0, I looked at all of these things and I said, these are great things coming up for this company. And I came up with a number that I thought was valuable. Maybe it was trading at $2 here and I thought it would be worth $5 over here. But here's the thing. What I was looking at was information that was publicly available. Meaning that not only did I know that information, but a number of other people knew that information too. In fact, we could go as far as to say that the market knew this information. So if the market knew the information all the way over here as well, why wouldn't that stock be priced at $5 right now if all of these things were known? Unless, maybe, given all of those things, $2 is actually the fair value, given those things. Meaning that as we move forward in time, if these events do occur, we're still going to be at $2. This is a big mistake that traders make. They confuse a very important thing that I'm going to break down for you right now. They confuse tradable versus non-tradable information. If information is publicly available and everyone else in the market knows it, including the person on the other side of our trade, why should it make us money? And we can't assume that the person on the other side of our trade is less informed than us or knows how to work with information less than us, because we actually don't necessarily know who's on the other side of our trade. We need to do research to try and narrow it down, but off the bat, we can't assume that the news is not priced into the stock, that the guidance is not priced into the stock. All of these things are already known to the market and therefore are considered in today's current price. So what makes something good tradable information? Well, they have a number of characteristics that will make something tradable information. One could be that it's not well known. Right? Maybe this is information that you've created. right? You ran some tests on the market and you found a correlation in something that is not well known to everyone else. It's not public information. Something else that could be considered tradable information is perhaps there's a structural inefficiency. Maybe there's something that exists in the market for a reason. So for example, funds have an obligation to hedge their Delta One positions or their stock positions. So what they do is they go out and they buy out of the money puts or they sell out of the money calls as a way to hedge their risk in the Delta One space. This is a structural inefficiency that drives up the price of the out of the money puts and drives down the price of the out of the money calls. Something that we're going to discuss more in depth in silver in a topic called skew. A final characteristic of tradable information is that it's not easy to take advantage of. Not easy to use. So for example, we ran tests and we see that there is actually an edge in selling options around an earnings event. But using that information is not necessarily easy. Because if you remember from our 3 circles of volatility model, the earnings move can represent 30 to 70% of how much a stock moves in a given year. Meaning there's huge moves driven by these events. A lot of people don't want to be taking on that risk, even if in the long run there is an edge there. So whenever we look at the market and we think about the research that we're doing, we need to ask ourselves, are we looking at tradable information or are we looking at non-tradable information? And this can help you. You can probably look back at some of the trades you've taken and go, that's why my research didn't pay off. Because a lot of the time, traders are looking at non-tradable information, thinking it gives them an edge, and then they're left scratching their heads, wondering what went wrong when the trade doesn't go their way. So now that we understand the difference between tradable and non-tradable information, we're going to move over and we're going to talk about how we use research to actually give us more confidence in our trades. So to start this off, remember, the first thing we're doing is looking at the data, right? So we go out and we look at the data, and that gives us some sort of output, right? Let's say that we're looking at the implied volatility versus our forecasted volatility. We might see something like IV equals 150% and our forecast equals 75%. Well, given the data, if we look at this, we will say volatility is overpriced. Based on this, the market might be implying that the options are worth $10, but given our forecast, we think they should only be worth $5, which would mean that we think the options are overpriced and we should go out and we should be selling them. But here's the thing that we need to be very careful of when we're looking at the data. When we're looking at something like the IV versus our forecast. What that is it doesn't tell us why. That right there is the key to the puzzle. In order for us to really be able to take advantage of this and have confidence in this, we need to go beyond just this data and understand why there is this gap. Why is implied volatility expensive? We go out and we can objectively say, based on the data, implied volatility is really high, the options are expensive. But what if there's a reason why? So maybe there's a reason why that implied volatility is so high. For example, maybe company XYZ has been involved in a big lawsuit recently and the verdict is coming out in the near future. If depending on that verdict, the company either goes under or goes up in value a lot, the implied volatility is going to be through the roof because we're going to see a huge move in some direction depending on the result of that lawsuit, right? And that makes sense. All of a sudden we understand why, the stock hasn't been moving that much right now, but we know that there's going to be some sort of big move in the future. Now we go, okay, maybe we'd actually stay away from that trade because implied volatility is high for a reason. Another reason why implied volatility might be high is insider trading. If we go out and we can't understand why, we look at it and we go, I actually don't know why that's so high right now. I don't see any retail trading it. There's no news events that cause this thing to blow up. Why is it so high right now? It could be insider trading. And that is something that we want to avoid. So my entire point of this talk is to tell you that understanding why there is an inefficiency is the entire purpose of us doing research on our trades. We want to have a good understanding of what's going on behind the numbers to give us confidence in our trade. That is how we filter out a lot of the bad trades, is actually through our research. Data takes care of the start, but then the second step that we always follow up our data research with is trying to find a logical reason why. We want to find a logical reason why this is the way that it is. If we're able to do that, we now have a trade that has a very good conviction rate. We like this trade, not only because there's an inefficiency, but also because there's a logical reason why that inefficiency is there. We understand what's going on in the situation. And that is an extremely powerful spot to be as a trader, because not only do you have the numbers on your side, you have the logic on your side as well. And that's what we're going to be looking for every single time that we place a trade. There's a lot of work that goes into each trade, but we have to remember, trading is a profession. People do this for a living. And if we want to compete in this game, we need to take the steps. We need to do the research. We need to look at the data. We need to do everything required to give us a real edge in the market. By combining data with logical reasoning, we are able to paint a full picture of what's going on. If we're only looking at the data, we are a little blurry still. There's still some stuff that we don't know. And if we only look at the logical reason why, it's the same situation. We may not even have an edge to begin with. So we need to use both in conjunction with one another to really understand what's going on. And if we do that, we're well on our way to placing really good trades. What you're going to see is this is actually a part of the 3-step process we're going to be teaching you for going out, finding, and capturing inefficiencies in the market. But for now, let's move on to some examples of doing research that could really benefit you as you go on your trading journey. See you in the next video.